Welcome back to the deep dive. Today we're digging into something really interesting. Oatly's Q3 2025 earnings call, but specifically the Q&A session.
Yeah, we're skipping the prepared stuff. The real meat is always in the questions.
Exactly. That's where management gets put on the spot. We've got the CEO, Jean-Christophe Fladen, COO, Daniel Ordonez, and CFO, Marie-Jose David, facing analysts from, the big firms like Morgan Stanley, Barclays.
Right. And our mission here is to really unpack what investors are worried about, because this Q&A, it really highlighted a tale of two markets for Oatly.
The tale of two markets. Okay, tell me more.
Well, you've got Europe, which seems to be firing on all cylinders, growing fast, strategy working. Then you've got North America. Much tougher story. Complex, lagging behind.
Okay, so that's the core tension. We need to figure out, one, what's the secret sauce in Europe? What are they doing right?
And two, crucially, when does North America get its act together? When do they finally overcome these headwinds everyone talks about and start delivering that profitable growth for 2026?
Got it. So analysts were likely asking about sales growth, this new playbook they mentioned, and, of course, the path to profitability across the board.
Precisely. They hammered them on those points.
Yeah.
So let's start with the good news. Let's talk Europe and International, the E&I segment. Revenue up 12% in Q3. Pretty
That 12% is strong. Management said they have solid continuity of strategy there, but what does that actually mean? What's driving it?
It really comes down to experience and taste. That's the mantra. The COO, Daniel Ordonez, he called it their taste and flavor bonanza.
Oh, bonanza. Okay.
Yeah, and here's a really key point an analyst brought up. European retail consumption of oat milk actually accelerated in Q3. It grew faster than the whole plant-based milk category.
Wait, hang on. Faster than the category. So they're not just stealing share from, like, soy milk or almond milk.
Exactly. It suggests they're actually growing the whole pie, bringing new people into oat milk.
Okay, that is significant. So how are they doing that? How are they getting people to try it for the first time? Just, like, ads?
It's much more hands-on than that. It's quite clever, actually. It links back to coffee culture. They've got this dedicated global team.
Oh, yeah. How big?
Not huge, actually. About 60, maybe a bit more, barista market developers. But they're strategically placed. Mexico City, Seoul, Paris, you name it.
60 people globally. Still seems kind of small for a company like Oatly. What are they doing? Like 1,500 hours a week, the notes say.
Yeah, they're basically embedded consultants. They work directly with cafes and partners to essentially renovate their menus, create signature drinks.
Ah, okay, so it's experiential.
Totally. The model is
Yeah.
you go to a cool coffee shop, maybe a festival pop-up, and you try a really unique drink. They mentioned a new matcha oat drink. Remember the popcorn flavor thing?
Yeah, I do vaguely.
Right, so you try that, you have a good experience, you associate Oatly with that great taste, then you go looking for it in the supermarket.
So it's not just, here's an alternative to milk. It's positioning Oatly as an experience canvas for drinks. That's smart. That's how they drive trial.
Exactly. It bypasses that initial oat milk hesitation.
But Europe's got to be competitive. You've got other plant milks, store brands. How do they handle the cheaper private label stuff? Are they getting dragged into price wars?
Management seemed pretty confident they're avoiding that. They talked about commanding a strong premium. They're in the value game, not the price game, was the phrase used, I think.
The values game.
Right. Their logic is, look, this category is still young, maybe only 30% household penetration in Europe. So there's still like 70% of the market to go after. They see themselves as driving that growth, creating new demand for premium oat milk, which lets them keep that price point.
Okay, that European playbook sounds really solid. Impressive, actually. Now, let's do that 180-degree turn you mentioned, North America. Why is it so much harder there? What are these headwinds masking the progress?
Yeah, the North American picture is definitely more complex. Management argues it's mostly mechanical stuff, not that consumers don't like the product.
Mechanical?
Two main things. First, they're still dealing with the fallout from losing a chunk of business from a very large customer a while back. That single customer used to be nearly 30% of their revenue 3 years ago. Now it's only 10%. So the year-on-year comparisons just look bad because the base is so much lower.
Okay, that makes sense. Big customer loss takes time to lap. What's the second headwind?
The second one was frozen SKU rationalization.
Jargon alert. What's that mean in plain English?
Yeah. Basically, they're cutting back on some of their niche frozen products, like maybe ice creams or novelties that weren't selling well, to really focus on their core drinks. Smart move for focus, but it means fewer items sold overall in the short term, which hurts the top-line number.
Gotcha. Cleaning up the portfolio.
Right. And when they adjust for those two specific things, the customer loss and the SKU cuts management said the underlying business in North America actually grew 5% in Q3.
Okay, 5% underlying growth. That's not bad. It shows there is some momentum. But investors want clarity. When do these mechanical issues stop dragging down the reported numbers? When is the comparison finally clean?
They gave a pretty clear timeline on that. They expect to have a clean base, really, around Q2 2026.
Q2 2026. Okay, still a few quarters away.
Yeah, so until then, it's about setting the stage. They mentioned getting new distribution starting Q1 2026, and they're really pushing into the club channel, Costco, places like that. They're in 5 Costco regions now, planning at least 2 more, plus adding more products there, building that volume base.
So the big question then is, can that European playbook, the taste and flavor bonanza, actually work in the US? Is the American consumer fundamentally the same, or is that wishful thinking?
They tackled that head on. They seem very confident, arguing the underlying consumer trends are fundamentally similar.
Is there evidence?
Well, a couple things. First, they said the U.S. coffee scene evolved just like Europe's, from basic hot coffee to these, fancy cold brews and experiential drinks. That fits their model. Second, younger people everywhere seem obsessed with flavor and new taste experiences. That's a global trend.
Okay, those are trends. What about product preference?
That was probably their strongest point. They said blind taste tests show the exact same result in the U.S. as in Europe. About 50% of consumers prefer Oatly over traditional dairy milk in a blind test.
50%. Okay, that's compelling. So if the preference is identical, why is the U.S. market so much slower to take off? What's the bottleneck?
It comes down to the structure of U.S. retail, the sheer complexity.
How so?
It's all about shelf resets. In Europe, apparently it's easier or quicker to get new products onto store shelves, expand your space. In the U.S., the big grocery chains typically only rearrange their shelves like once a year, and the windows to get included are really narrow and competitive.
Ah, okay, so even if 50% of people prefer it in a taste test, getting it onto the shelf where they can actually buy it takes way longer in the U.S.
Exactly. It dramatically slows down that conversion from preference to purchase. That's why they keep saying U.S. progress will be step by step. It's not a floodgate opening overnight.
Makes sense. Let's talk profit in North America then. The quarterly EBITDA has been up and down. Is that because the U.S. operation is just less efficient structurally?
Management pushed back on that idea. They claim it's not structural cost issues. It's tied to those volume problems we discussed, what they called absorption headwinds.
Absorption headwinds. Okay, explain that.
So think about their factories. They have fixed costs running the plant, the machinery, etc. When their sales volume dropped because of that customer loss and the SKU cuts, those fixed costs had to be spread over fewer units of product.
Which makes each unit look more expensive to produce.
Precisely. It crushes the gross margin temporarily. They also mentioned some supplier penalties in Q3, kind of a true-up cost related to sourcing changes. But the core message was, once volume comes back, those absorption headwinds disappear, and the U.S. should drive strong profit growth, just like Europe.
Okay, so the profitability hinges on getting that volume back up. Let's shift to the overall company financials then. Guidance and cash flow. The CFO reaffirmed the full-year adjusted EBITDA guidance, right?
Yes, Marie-Jose David confirmed the range is still $5 million to $15 million, but she did signal they expect to land in the bottom half of that range.
Okay, bottom half. Why the caution?
It seems mainly due to timing. Some expected sales in Greater China are shifting, looks like pushing out a Q4, which hurts the Q4 top-line number.
Ah, okay. But there was some good news on margins for Q4, wasn't there?
Yes, exactly. Offsetting that slightly lower top line, they expect Q4 gross margin to actually improve quite a bit by 200 to 300 basis points compared to Q3.
And why is that?
It ties back to that jargon we just deciphered, those supplier penalty accruals they booked in Q3. That was described as a one-time true-up of past costs. Since that won't repeat in Q4, the margin naturally bounces back. It looks cleaner.
Got it. So, looking beyond just Q4 in 2025 cost savings, is this a permanent thing now or just a temporary belt tightening?
The CEO, Flatten, was pretty emphatic here. He framed it as a culture shift. Finding savings in the supply chain and SG&A, overheads has gone from being an urgent necessity a couple of years ago to just a permanent daily mindset.
So continuous improvement baked in.
That's the idea. They didn't give specific dollar targets for 2026 yet. That's still in budgeting, but the message was clear. Operational discipline is here to stay.
Okay, let's zoom out to the balance sheet and cash. Free cash flow. It was an outflow, technically, $5 million in Q3, but that was way better than last year, right? $22 million better.
Yeah, that improvement is key. It shows better control. And what's driving it, it's really operational efficiency hitting the numbers.
Like what specifically?
They highlighted their cash conversion cycle. It's now below 40 days, which they said was the best level since the IPO.
Cash conversion cycle. Remind me what that measures again.
It's basically how fast the company turns its investments in inventory and other resources back into actual cash. So getting it under 40 days is really good. It means they're managing inventory better, collecting payments faster, just running tighter. Plus, disciplined CapEx, they're only expecting to spend about $20 million total for the year.
Very disciplined. Okay, and lastly, they made some big moves on their capital structure just recently in early October. What did they do?
Yeah, that was significant financial housekeeping. Three main things. They issued about SEK 1.7 billion in new Nordic bonds.
Okay.
They used that partly to prepay their existing, more expensive term Loan B debt. And critically, they also bought back and canceled some of their convertible notes.
Convertible notes, those are the ones that could turn into stock shares later, right?
Yeah.
Diluting existing shareholders.
Exactly. So doing this has a couple of big benefits.
What are
First, immediate cost savings. They expect to save about $5 million a year in interest payments just from this refinancing. Second, and maybe more important for investor sentiment, buying back those convertibles reduces the potential future share dilution by around 10%. That's about 40 million potential shares taken off the table.
Wow, okay. So lower interest costs and less potential dilution. That definitely cleans things up.
Yeah, strengthens the balance sheet, cuts ongoing costs, and just signals better financial footing overall.
So bringing it all together from this Q&A deep dive, it really is that tale of two markets, isn't it?
It really is. You've got Europe accelerating, proving the playbook works, this taste experience-led strategy that's actually growing the whole category.
Yeah.
And then you've got North America still wrestling with these specific mechanical issues, the customer loss, the SKU cleanup, the slow retail resets, even though the underlying consumer seems just as keen on the product as in Europe.
And the whole story, the whole investment case looking towards 2026 really hinges on whether and when those two speeds converge, when North America finally catches up. So here's the final thought for you, the listener, to chew on. We heard the underlying U.S. consumer preference is strong, that 50% blind taste test figure is powerful. And management pinpointed the slow annual U.S. retail resets as the main delay. So what happens to North America's growth trajectory when they finally cycle past those headwinds, the customer comp, the SKU cleanup, starting around Q2 2026? How fast could that volume snap back, and how quickly could it translate into the kind of profitability they're now showing consistently in Europe? That potential turning point, that inflection, is really the story to watch for Oatly.